There's not a chance Hormuz will reopen anytime soon. Well, at least not to the extent that the average punter is betting on. For weeks, we've had the TACO trade, but it's giving way to a scarier trade. The NACHO trade. Who would have thought nachos are scarier? If you're utterly confused why an Australian Italian is talking about Mexican food on a finance channel, let me explain. TACO stands for Trump always chickens out. It's a term coined by Wall Street traders for the pattern where Trump makes massive threats, then chickens out. Like the tariff wars, Greenland, you get the idea. Well, Wall Street thought Trump would TACO out of Iran, but it's hard to TACO out of a shooting war. Enter the NACHO trade. Bloomberg's Javier Blas put NACHO on the map in late April. State Street Global Advisors traders publicly confirmed they were positioning around it on May 7th and 8th. Approximately 920 million in crude oil shorts hit the tape exactly 70 minutes before Axios broke the story on the US-Iran 14-point peace deal on May 6th. That's 70 minutes. Oil dropped over 12% in the hour that followed. Today I'll walk you through exactly what NACHO and TACO mean for the markets and the $7 billion pre-announcement short pattern that has the DOJ and the CFTC opening a joint investigation, and why both outcomes of this trade confirm what we've been talking about for weeks. The cycle has rolled into stage 5 to stage 6 transition. Alright guys, hit the like button and subscribe to the channel. And if you want the full framework on the 18-year cycle, there's a 3-part mini course, the link's in the top of the video description. So let's get started. NACHO stands for Not a Chance Hormuz Opens. It is a structural bet that the Strait of Hormuz disruption is now a permanent macro regime change, not a temporary geopolitical shock. Long oil, long shipping insurance, long inflation hedges, short rate cuts expectations, long volatility. That's the long-term play. But in the short term, we'll likely see the oil trade ease as every Tom, Dick and Harry already knows about it. And if everyone knows about it, then it's definitely priced in. TACO, as I said earlier, stands for Trump always chickens out. It is the parallel bet that every Trump escalation gets reversed within days. Buy the dip on the threat, sell the rip on the de-escalation, and ride the pattern repeatedly. And these are not memes. I know they sound like some kind of joke, but I'm dead serious. These are real institutional positioning frameworks driving billions in flow. And they are mathematically opposite. Only one can be structurally correct, although the smart money appears to be using TACO tactically while positioning for NACHO physically. White House spokesperson Kush Desai dismissed the NACHO crowd publicly this week, calling them the same geniuses who doubted Trump on drug pricing and trade deals. That's the official line. Now let me show you what the actual money is doing while the spokesperson is pushing this narrative. According to Reuters investigation, approximately $7 billion in oil short positions were placed in clusters before major Trump ceasefire announcements between March and May of this year. 5 separate clusters, each one preceding a market-moving announcement by minutes to hours. March 23rd, roughly 500 million in shorts, 15 minutes before Trump announced a delay on strikes against Iranian power infrastructure. April 7th, nearly $1 billion in shorts, hours before a 2-week ceasefire announcement. April 17th, 760 million in shorts, 20 minutes before Iran's foreign minister announced Hormuz would reopen. April 21st, 430 million, 15 minutes before Trump extended the ceasefire indefinitely. And then May 6th, 920 million in crude shorts, 70 minutes before Axios published the 14-point peace deal memo. Oil dropped over 12% on the report. That single trade potentially generated 125 million in profit in just over an hour. It's 125 million in an hour. The DOJ and the CFTC are now jointly investigating at least 4 of these transactions, totaling over, get this, $2.6 billion. And these trades are not routine hedges. They're high conviction directional bets. The timing and the size are statistically impossible without advanced knowledge. Senator Elizabeth Warren and Representative Richie Torres have formally demanded investigations. The White House issued an internal warning to staff in March against using confidential information to trade financial markets. They're not even supposed to have accounts to trade these markets. At least that's what we see when we're setting up brokerage accounts. Anyway, the administration itself put a memo out telling its own people to stop trading on what they were hearing in meetings. You don't use that memo unless you know somebody is already doing it. And I think we're all sick of being played by the politicians with flip-flop policies, let alone getting blatantly rugged by them in the markets. Now here's the rhetorical question forming in the comments. If the smart money is shorting oil ahead of every ceasefire announcement, doesn't that prove TACO is the winning trade? Well, not exactly. because the same desks that are tactically shorting oil ahead of headline events are physically positioned long for the structural disruption that no headline can fix. Before the war, the Strait of Hormuz handled between 140 vessel transits per day. Now that number is sitting between 0 and 7 daily transits. That's approximately 5% of pre-war levels. The Strait carries roughly 20 to 25% of the world's oil and 25% of global LNG. The bypass pipeline capacity through the UAE and Saudi east-west line handles about 35% of normal Strait throughput. That leaves about 65% structural gap that no land alternative can cover. Iran has now established a formal regulatory agency to vet, tax and control vessel passage. That is the institutional architecture of a permanent blockade, not a temporary protest. But something the news media isn't telling us is that Saudi Arabia don't need these prices that high. They don't want them that high because it will affect their economy. On the other hand, Iran needs them that high. Now, the war risk insurance premiums have moved 20 times higher than pre-war levels. Approximately 1,500 commercial ships and 20,000 sailors are stranded in the region. 41 recorded security incidents since the war began, 26 of them direct attacks on ships and crew. The maths doesn't come close. Goldman Sachs is projecting global oil inventories fall to approximately 98 days of demand by the end of May, an 8-year low. Refined product stocks like jet fuel and LPG have already fallen from 50 days pre-war to 45 days. The IEA has called this the largest supply disruption in history. Goldman's adverse scenario puts Brent over $100 in Q4. Their worst case 2.5 million barrels per day disruption scenario takes Brent towards 120. Brent's currently trading in the vicinity of 100 to 114 range as we speak. The US is exporting a record amount of crude to fill the gap, draining the strategic petroleum reserve. US gasoline prices are up roughly 52% since the war began and over $4.50 a gallon nationally. Santa Barbara is sitting at $6.70 per gallon. Even Chevron CEO Mike Wirth said publicly that even if the Strait reopened tomorrow, it would take months to normalize shipping and potentially over a year for prices to return to pre-war levels. The 1973 OPEC embargo is the closest historical parallel. In 1973, alternative routes eventually absorbed the rerouted supply. But you can't really bypass Hormuz today. That is the physical reality NACHO is built on. Now let me explain the TACO case. The TACO scenario is straightforward. Iran signs the 14-point memo within 30 days. The Strait reopens, oil crashes back somewhere in the 70s, and the S&P 500 squeezes higher into a relief rally as fund managers chase the move. Trump gets the de-escalation win heading into the November midterm positioning. There is real pressure forcing this outcome. On May 7th, the US Court of International Trade ruled Trump's 10% global tariffs unlawful under Section 122 of the Trade Act of 1974. American businesses paid over $8 billion in Section 122 tariffs in March alone. Toyota just reported a 19% drop in the annual profits, with tariff policies erasing roughly $9 billion from its operating income. The current tariff regime is the largest US tax increase as a percentage of GDP since 1993. So yes, there's real political and economic pressure to close a deal. But here is why TACO winning still does not guarantee the bull market goes on, or at least on indefinitely. Kevin Walsh's nomination cleared the Senate Banking Committee on April 29th in a 13-11 party line vote. Full Senate confirmation is expected the week of May 11th. Powell's term as chair expires May 15th. Walsh walks into a building where the April 29th FOMC meeting just produced a historic 4-member dissent, the first since '92. The federal funds rate held at 3.5 to 3 3/4. Markets are pricing a 90 to 96% probability of another rate hold at Walsh's first meeting in June. And the March CPI already printed at 3.3%. So even if the Strait opens tomorrow, the energy shock has already pushed inflation expectations higher. Walsh has publicly signaled he wants to reduce the Fed's $6 trillion balance sheet, which analysts warn would put upward pressure on long-end rates. The committee is fractured along the most hawkish fault line in 34 years. The Bank of America Global Fund Manager survey for April hit its most bearish reading in 11 months. But get this. Often that can be a contrarian signal. I'll talk about that more in a minute. Over 75% of managers are now expecting stagflation. Cash levels jumped to 4.3%, which is the highest since May 2025. And the net negative 36% on global growth expectations, which is the sharpest decline since March 2022. So even in the TACO scenario where Trump closes a deal in 30 days, Walsh inherits sticky inflation, a fractured FOMC, no room to cut, and a balance sheet he wants to shrink. That is a stagflation trap on day one. And yes, the market can squeeze higher on a TACO or a Leaf rally and still be sitting in the exact configuration we just walked through, economically speaking. Now let me show you what the smart money is actually doing in response to all of this. Berkshire Hathaway just reported Q1 26 earnings, cash and treasury bills sitting at $397 billion. It's the largest defense cash pile in their 60-year history of Berkshire. The translation, prices are too high and they're waiting. Berkshire's recent major deployment was $9.5 billion with OxyChem's acquisition. Real assets, energy infrastructure, physical commodities. Now back to the Contrarian indicator. The Bank of America Global Fund Managers Survey for April registered the most bearish sentiment reading in 11 months. 193 fund managers. Sentiment dropped to 3.7 from 5.6 the month prior. This extreme bearishness could be a contrarian positive if a ceasefire sticks. And to date, nothing has. And Trump has even deployed missiles as recently as last week, calling those a love tap. Seriously, you can't make this stuff up, even though it would be better for humanity if it were all just a weird, sick dream. So, 3 independent classes of capital, corporate, institutional, and sovereign, all positioned identically. Cash heavy, short risk, long the volatility, hedged for repricing. Germany just cut its tax revenue forecast by 87 billion euros, that's roughly $100 billion, directly attributing the cut to the energy shock and defense costs. Now bring this all back to the framework. If you follow this channel, you know by now we're firmly in the winner's curse phase of the 18-year US real estate and economic cycle. The winner's curse phase is where every asset class except equities flashes the warning, and equities are the very last thing to capitulate. The bond market is pricing in no rate cuts for 2026. The oil market is pricing structural disruption. The dollar is weak. The equity market sits near record highs, pricing essentially none of it. That's pretty normal. That's the core thesis. But if you want a full breakdown on how this stage 5 to 6 transition fits into the broader 18-year cycle, the 7 stages and the signal stack, the 3-part mini course is in the top of the video description. There's a link there. So part 1 is the cycle itself and why it has repeated over 220 years. Part 2 is where we are right now in the timeline. And then part 3 is how we're actually positioning ourselves for what comes next. Completely free, links in the top of the video description. So let's bring this all back together. The NACHO trade and the TACO trade are not memes. They are the cleanest framework of where institutional capital is actually positioned right now, while retail is busy buying the next weekly green close on the S&P 500. If NACHO wins, Brent grinds higher to our upper targets of over 120 a barrel, the Fed has no room to cut, and Walsh inherits a stagflation trap from day one. But if TACO wins, Iran signs a 14-point memo, oil crashes back into the 70s, the S&P squeezes one more leg higher, and Walsh still inherits a fractured FOMC with sticky inflation and no room to cut. Both outcomes confirm the cycle is in stage 5 to 6 transition. Berkshire is sitting on $397 billion in cash for a reason. Central banks are buying gold for their own reasons. The DOJ is investigating the $2.6 billion in suspicious oil shorts for a reason. Project Freedom launched on May 4th and was paused by May 6th after Iranian missile and drone attacks on escorted ships, with Saudi Arabia and Kuwait pressuring Washington to back down. Every prior moment in the last 100 years where the bond market, the commodity market, and the smart money positioning all diverge from the equity market, this violently has resolved in the same direction. The equity market eventually capitulated to the message every other asset class was already sending. So now I want to hear from you. After everything you just heard about the NACHO trade, the TACO trade, probably getting hungry, the $7 billion in pre-announcement oil shorts and the 14-point memo that may or may not get signed, which trade wins by July? Does Trump close the Iran deal in 30 days and prove TACO right with the Strait reopening and oil crashing back into the 70s? Or does Hormuz stay shut? NACHO take Brent higher and above the 120 as our worst case scenario, and Kevin Walsh walk into the building on day one already trapped by an inflation print he cannot or should not cut into. Drop your call in the comments section. I'll be reading every single one of them and replying to as many as I possibly can. Hit the like button, subscribe to the channel, and grab the free 18-year cycle mini course in the top of the video description. I'll see you guys in the next video. Until then, take care and peace out.